Hi guys, hi everyone. I am Sham and I have Kishan with me. Welcome to the third episode of Free Flow. And today we have something really cool. Last week I think we touched upon a little. We discussed diversification and how it reduces sequence risk. But we mentioned in passing that markets tend to trend. If a market starts going down, it tends to keep going down. So one way to sort of reduce drawdowns and make sure that you stay disciplined to your allocation is to use some sort of a trend signal and take a tactical approach based on that particular trend signal so that you kind of get out of the market before the fall gets really bad. So Kishan, do you want to sort of take it away from here?
Yeah, sure. So, so first of all, hey Sham, it's been a interesting, post this, because I've been working on the research part of it, and it's been quite revealing. Just for example, uh, when you start investing, or like whoever like asks you a simple question, right? Is this the right time to invest? What someone is asking for you is not whether what you think the market will do. Say 10 years down the line, whether they should invest. I mean, for 10 years and hold something. What they're basically asking you is, if they invest today for the next 2 or 3 years, can you expect a positive outcome, right? and and that itself is a very tactical approach, or a question, meaning that people just want to be opportunistic and take advantage of a short-term focus that you might have. um,
Right. Honestly, I don't know how to answer that question myself. So, and typically, I have seen people address this through, valuation metrics, through keeping a tab on sentiment, what has been going up and down. Is there going to be war? Is there going to be a plague? Nobody knows anything.
yeah.
So I typically say that look, you got to be selectively bullish or be opportunistically looking out for stuff. And lately, my go-to thing has been just if the market is going down, I'm like, yeah, the market is in a bearish phase, and try to figure out if the investor is looking for value or looking to follow a trend. And if he's looking for value, I tell him, oh, the market is all-time low, so you should probably buy it. And if he is looking for following a trend, I would say just wait a while till the market starts trending up again and jump back in. Because there's no single good answer. I haven't found a single good answer for this question. Like, should I invest now or should I wait?
Yeah, and I think tactical investing is is it is just that. I mean, finding the right opportunity, or or finding the right time to invest, or to hold back. And the question becomes deeper, because I mean it's a simple thing to to know, but then what's the right time to invest, or what's not the right time to invest, is a very deep question. I think this 15-minute video can stretch out to many hours, just trying to figure out. I'm answering that. Um, but I think the most important thing here is to have some rules. Because if you don't have rules, then every day I switch on CNBC. It would tell you to go buy or sell. Based on what the market is doing, and that is a very easy way to get swayed. By by
Right.
emotions.
So, look, whenever people start off, they start off by looking at CNBC, right? So, in the US, they look at Jim Cramer or somebody like that. And in India, we have the steady stream of people coming on the screen and saying, buy this and buy that. So back in 2014, I tracked like one of those TV gurus. I don't want to say his name out loud because, I don't want to get sued, but that was like a roaring bull market. and he would come every day, and he had some software. He used to run some sort of a PMS. I don't know if he had real clients or not. And he would say, you got to buy this, you got to buy sell that, and profit book here, and leg in there. So I was like, okay, fine, let's track this whole thing. And during the whole bull phase, Nifty was roaring ahead, and this bugger made 2%. Like Nifty was way ahead, like some 25-30% up, and all his calls, if we aggregate it together, he made 2%, and that's not even like taking into account transaction
Right.
costs. And I was like completely mind blown by this. So yeah, like a blind monkey would have made money in that market, and
Yeah.
this fellow couldn't.
Yeah, and I think I mean, what is right? Because if you just just read the newspaper and listen to views and stuff without rules, what would happen is that you would enter and exit markets based on what the thinking is,
Right.
and the thing is, and that thinking would just lead to you just blowing up your account because you'll be like all over the place. So I think the first thing that someone should do is to have some rules, and those rules need to make intuitive sense. Like like if you base a rule on, say, I'll buy when the market is extremely depressed, right? Then it's a good idea for you to define what you mean by depressed. Like either in a qualitative way or quantitative way, and and you must have some kind of a measurement. I mean, for either of those factors, and then you start thinking about whether how this performed, say, in the previous times. Like say, if you have the data, you can go back 20-30 years and see how the strategy performed. And if the test holds up, if your simple historical simulation holds up, and it makes intuitive sense to you that okay, this would work because this makes sense because of this reason, then it's then you're in a good starting place. At least you have something that works. And and then and once you have that, I think the second most important thing is to have discipline. You must always implement a strategy without any emotional, like, bias, because I mean, just for example, if the market is depressed, right, it is depressed for a reason, right? And at that moment, you'll be like, oh my god, if I invest now, there'll be a I mean, there's a big calamity that will happen, and I should not invest now, I should probably wait. And you're basically uh, violating your own rules of the strategy. I mean, you worked so hard, trying to historically backtest this particular strategy that you made. That, okay, what do you mean by depressed markets, and what do I mean by you know uh, you know uh, and will it work? And you spend so much time researching that, but when it actually comes to implementing it, people have aversion, because like, knowing something or doing something theoretically and like actually implementing it in real life is two different things. And and the moment you get that right, that you say, okay, I will start investing when the market is depressed, and I'll define the rule that I'll stick to it no matter what. Maybe that one time you'll be wrong, but over a course of a longer period, you should, if the strategy is good and it makes intuitive sense, and you've done your work right, it should work out for you, like 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 in the long run. And having that faith and having that discipline, um, it takes a lot of years. I've lost my hair
Right.
trying to get that right.
So in my experience, right? Exit is the easy part, right? Because everybody knows the bear case. So for example, like 2008, you could basically see the Western markets tank one after the other, and as an Indian investor, you could have made a sense that this is fine, eventually going to wash up on our shores. So the bear case is the easy exit. The same thing happened with this pandemic as well. So like a lot of investors, made the right call when they saw shit hit the fan in China, and exited back in Feb or something. But the problem actually is getting back into the market, because there's never really an all clear signal, right? So recoveries are always going to be patchy. And I still remember, like in 2008, 2009, the whole thing was green shoots, brown shoots, gray shoots, yellow shoots. They would try and read the economic tea leaves and say, oh, have we turned the corner? Are we supposed to like get back into the market? But that's the thing. So while the exit was a one-time easy call to make, getting back into the market it's really a tough call to make once, and especially once you made the right call once to exit. It's so easy to just stay on the sidelines and market and wait for it to show a strong bounce. That never really happens.
Yeah, and yeah, I mean, but but that's the problem with doing something that is discretion based, right? Because getting the timing right, it is impossible. For you to find the bottom, or for you to just know what will happen tomorrow. If someone can predict, that with almost zero certain, I mean, with certainty, I would chilling. I'll be chilling on a beach, and I think that is extremely hard, and that's why you know if you have a like a tactical approach where you think that you can take advantage of short-term opportunities, having rules and knowing what you're doing is still important. You cannot say, okay, I will invest when I think the market is it is at the right moment, because how do you know? Because you could invest when the market is at 7,600, I mean, when the market reached, and the market could have gone to 5,000. I mean, there's no reason why it could not have. But most people look at the chart and say, okay, if I invested at 7,600, today my portfolio will be up by 30%. They all, I mean, people assume that they can catch the bottom. Which is really hard. And I think what we did this week is interesting. Because if you just bought and held the Nifty over say 16 years, you would have made about 12.5% return, and less, which is not bad. It is pretty decent. But if you just implemented a simple rule, which is the 200-day moving average, which is where you are trying to invest above the based on the trend of the market, on the long term trend of the market. If you just bought it every time it crossed every time the index crossed the the threshold of the 200 moving average, and if you sold when it came below it, you would have made 14.5%, which is like 2% more every year for 16 years, which all adds up to about, I think, about 100% more. So if you just bought and hold Nifty, you would have 650 rupees with you if you like invested 100. But if you just did the opposite thing, you would have like 100 rupees more, which is real stuff. I mean, you might think, oh, that's not much, but that extra 100 rupees you can actually eat and go buy something else that you couldn't. And that's a very simple strategy for someone to implement. The most important part, I think, is if you just bought and held the Nifty, you would be down. You would have had to experience like bigger drawdowns of say 58% and 28% and stuff, while 200 moving average was much lower. I think the biggest drawdown was 28 and stuff. So it does help you know that if you, by implementing a few rules, of just able to be on the right side of the market, having some tools will help you like achieve your goals better. And there was, I mean, the point of this week's post where we just wanted to make a case that some rules help you like invest better. And we did the most simplest thing, which is the moving average, but someone can have indicators based on fundamentals. You can invest at a certain level of the market, based on certain factors, quantify those factors, and then invest be be invested or be not invested based on those factors. So I
Right.
think, you know,
With all these back tests, right? I have like one big, hang up with these things, is that see what you see as the 2% extra, right? It existed because the strategy was near impossible to implement back in the day, right? So
yeah,
during your back test period. So say you tested from 2004 through through now. So I would say that before 2010, it was near impossible to implement something like this. Probably because there's no liquidity in the market for an index product, or it could be because transaction costs were too high. I still remember that at one point in the cycle, brokers were charging 2.5% for delivery trades, right? So in that scenario, this sort of a strategy would not have been feasible. So money was left on the table, and and that's what we are seeing when we backtest and say, oh, this was such an excellent opportunity to be tactical. But the problem was that back then costs were so high, and the ability to implement this strategy was next to zero. So so that's what we are seeing now as excess returns. So I just like to leave it out there because this is like an objection that nobody can kind of answer for sure. And it is something that all backtests are going to keep surfacing again and again and again, because when you look at history, the market structure was different, the liquidity levels in that market was different, the players were different. So so we have to always keep that in mind when we present results, especially backtest results that don't incorporate these kind of dynamics, and these kind of dynamics are very difficult to sort of model out as well.
yeah, and I think that's very true because um, what makes an historical simulation or a backtest like accurate is based on the factor that on the market dynamics, whether those dynamics apply today or not,
Right,
and
right.
and markets change. Uh, and I think it is important for like every strategy to I mean, this is just the first step. If you had to like implement this in real life, you would have to go to many like iterations um, and see if that same strategy works today.
Right.
It's new market.
Right. And the same strategy might as well work. I'm not saying, it's not, it's not going to work at all. It's just that, the prior returns, the alpha that, was shown in the backtest may not really translate one to, to today's market. Right.
Yeah.
So you have to kind of, handicap, that a bit.
Right. But but from an intuitive, I mean, point of view, I mean, the idea of using anything is that it should make rational sense. That
Right.
somebody should be able to understand. Does this make sense? Like from a rational perspective, and that's, I think, is a very important factor.
Right, right. So, so this is one. So tomorrow, I think next week what we should probably do is compare and contrast the allocation strategy versus tactical strategy, right? So we can show how one kind of wins over the other, at certain parts,
Yeah.
of the market. That'll be an interesting thing to see, because with an allocation strategy, there's not much in transaction costs. There's no daily maintenance, whereas I think in tactical strategies, I think you looked at daily ones. I mean, or weeklies. What did you look at?
I mean weeklies.
Weekly. So every Friday, at market close, you're supposed to do some calculation, right? So not many investors want to get into that. So
Right.
let's see how they compare and contrast next week.
Yeah. Sure.
All right. So
Sure.
thank you for coming online, Kishan, and thank you guys for watching Free Float. Catch you next week.